Hello and welcome to Portfoliosense. It does what it says on the tin, our latest video on our investment strategy. I'm Peter Robbins and I'm the investment manager here at Henwood and I'll be taking you through the slides today. So during this video, I'll be looking to cover a brief refresher on some of the principles adopted in Portfoliosense, then giving a brief oversight of the benchmarks that we use to compare our performance against, how we've performed during 2024, but also the last 10 years, whilst also finishing off with some of the things that we look to avoid within Portfoliosense, which should aid our long-term performance. So, brief refresher on Portfoliosense. As most of you should know, Portfoliosense is evidence-based. This means we use academic research and market data to make our decisions. These decisions on things like including small and value exposure within the portfolios are aimed at potentially lowering some investment risks, but also with the aim of hopefully maximising returns over the long term. We look to control costs by utilising low-cost funds. If we've got the choice between two funds which achieve the same objective, naturally we will be drawn towards the one that has the lower cost, because as we know, costs help generate returns over the long term also. Finally, we look to diversify across countries, sectors, asset classes, and I've actually taken a look at this on the next slide with some recent topical news headlines. So, as I touched on previously, there has been a lot of headlines in the investment world around the Magnificent Seven. Now, the Magnificent Seven are Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla. And a lot of the headlines have been about these 7 companies making a significant proportion of indices. As we can see here on this first bar for the MSCI World, the MSCI World is a proxy for developed markets. Within that indice, there's 1,396 holdings. And here we can see that those 7 companies amount to circa 23% of the index, so making up a massive chunk. If we take a step further back, I'll move on to the next bar. This is the MSCI All Country World Index. Now, the difference here between the World and All Country World Index is this starts to include emerging markets, whereas the MSCI World focuses on developed markets. So in the All Country World Index, there are 2,647 companies, and these 7 companies make up just over 20% of the index. Now, the third and fourth bars here on the chart are the exposure to these 7 companies in Portfoliosense Global and Portfoliosense Earth. And we can see that this is significantly lower than the indices. We achieve this by introducing value, smaller companies in global real estate into the growth element of the portfolios. And here, particularly in relation to value and smaller companies, we introduce just over 4,500 holdings in the global portfolios and just over 3,500 holdings in the Earth portfolios. So by introducing those, we're reducing the impact of the Magnificent Seven on a portfolio, but also we want to maintain some exposure to these companies because the reason that they've grown to such a dominant position, so to speak, within the global indices is the growth that they've generated as companies. So equally, we need to make sure that we're holding these companies so that we benefit from the growth, but also just to make sure that we're not too exposed should there be any changes to those companies. So when we talk about diversification, it's all about trying to mitigate risk. If we looked at the holdings within a portfolio, we'd expect to see all of the holdings performing differently. That's so that when one doesn't perform so well, hopefully another holding within the portfolio does perform well. So moving on to benchmarks. As most of you should know, we compare our performance against the Investment Association. So just a brief overview really to give you some background. The Investment Association is a trade association for UK investment managers. These range from small independent UK investment firms to European-wide and global managers. Collectively, the Investment Association manage over 9.1 trillion of assets on behalf of clients in the UK and around the world, which equates to circa 10% of global assets under management. So a significant range or funds captured within these indices that we use. Whilst the Investment Association has a range of sectors, We focus on the mixed investment sectors up to the flexible. This gives us a comparison against our portfolio. So as you can see on the screen here, mixed investments 0 to 35, we compare to our bond portfolio up to portfolio 30. Next, we move on to mixed investments 20 to 60, which is compared to portfolios 40 and 50. 40 to 85% shares, 60 and 70 comparable, and then flexible are portfolio 80 to 100. It's important that because we don't adopt a tactical asset allocation where we chop and change asset allocations, some of the funds within these benchmarks will. Therefore, by comparing portfolio 40 and 50, to the mixed investments 20 and 60, that should give us a reasonable comparison or a best fit, so to speak. And that's why we compare each portfolio against those ranges. In terms of the first three indices, the percentage of equities are the maximum and minimum range that a fund within those sectors can hold in growth assets. For flexible shares, the fund manager has the option to hold up to 100% equity, which is why we compare it to our most higher risk portfolios. Another point to make is that these benchmarks, they include managers like Vanguard, AJ Bell, Bruin, Dolphin, Brown, Shipley, and it's a range of approaches. Some will be passive, some will be active, some, as I mentioned, will adopt a tactical asset allocation approach. So it gives us a wide span to see how we're performing. So let's take a look at 2024 and starting off with the global portfolios. So starting from the left on this chart, we've got the bond portfolio moving right across to the right where we've got portfolio 100. Now, 2024 was a really good year for portfolios. As we can see, the range of returns go from 3.8% up to 13.2%. And we really see here the risk premium being evidenced with, as the portfolios start to increase, as we move left to right, we see the returns increasing. Now, the orange bars noted are the IA sector performance for 2024. And we can see here that for last year, it's a really pleasing set of results for us. Every portfolio except the bond portfolio outperformed the equivalent sector. And in relation to the bond portfolio, we wouldn't really expect it to outperform the IA sector that we compare it to because there's no growth element there. And the IA sector that it's compared against can hold up to 35% in growth assets. So naturally, we would expect the sector there to produce a higher return than our bond portfolio. If we move on to the Earth portfolios, it's identical here. The returns are slightly different, as we would expect some variance between the Earth and global portfolios due to the ESG screening adopted in the Earth portfolios. But again, every portfolio outperformed the sector with the exception of the bond portfolio. So really positive year for portfolios as a whole. As you know, though, we don't like to focus too much on the short term and we like to take a longer term view because all investments should be for the longer term. So if we move on to 10 years, and again, reverting back to global portfolios, a little bit of a shift right down on the left-hand side where we can see that the bond portfolio and portfolio 10 have underperformed against the sector average of 27.1%. Again, I would expect portfolio 10 to potentially be below the sector given the disparity in growth assets. But again, every other portfolio we can see generating significant returns against the relevant IA sector. And in the case of portfolio 100, we can see that it's almost double the IA sector. So really pleasing set of results, not only for 2024, but also over the longer term. And unsurprisingly, the picture is identical then as soon as we move on to the Earth portfolios. Again, we can see that as soon as we start to increase the risk, the returns start to increase, but also the performance against the sector, again, being really pleasing. Now, one thing that I would just like to say is, as we know, investment is often a 2 steps forward, 1 step back. We don't know what 2025 is going to hold in terms of returns, but we need to make sure that we enjoy the returns when they're there. When things aren't going so well, it's all about not panicking and keeping that longer term view. In this last 10-year performance for both the Earth and global portfolios, we'll be looking at the COVID crisis, some of the cost of living crisis, yet we're still seeing the returns that we see here. So by remaining invested, sticking to the plan, we can see that returns are generated over the long term and not trying to focus too much on the short term positions. Now, a question that could be asked is, okay, well, why has Portfoliosense done so well against the sector? So I've tried to list here some of the things that we look to avoid in Portfoliosense, which should hopefully improve or aid performance. As I just touched on there, we don't focus on short-term positions and goals. We look to prioritise long-term views, look to see what the evidence tells us. That ties in with ignoring the noise. We want to stay focused on relevant information, not listening to distractions in the news. A little bit like I mentioned earlier about the Magnificent Seven, a lot of talk about the impact that could have in the concentration. Well, actually, we can see that our concentration is nowhere near the same degree as global indices. And actually, we don't need to panic about what we're reading in the news. As most of you hopefully aware, we avoid market timing. So we want to stay invested. We don't want to be picking and choosing when to come out of investments or markets. The evidence shows that if you miss even just the best one day in a certain time frame, it can have a significant impact on long-term returns. We look to limit how much trading we're doing. So, we want to limit how much we're buying and selling, which reduces costs, reduces time out of the market. And as I mentioned, avoiding high fees. Every little bit helps. Therefore, the lower cost the portfolio can be, the more return potential that's being passed on to you as an investor. We also don't chase trends. So, we resist the urge to add popular fads that are coming out, Bitcoin. You read about stuff in the news are going, well, actually, this is where you need to be investing. Well, what does the evidence tell us? What is it? And that reflects then also into the final point of we avoid making judgmental decisions. We want to make our decisions based on analysis, not emotions or biases. As an investment committee, we raise our concerns with each other, we challenge our views, but rather than siding with one person's opinion, we always revert back to what is the analysis showing us, what's the data showing us, and we make our decision based on that. If we combine all this together, along with the approach of Portfoliosense, we feel that this is giving us the best potential to carry on generating these returns in excess of the benchmarks that we compare ourselves to. Now, I've covered briefly some bits here. Should anyone listening have any further questions, please reach out to myself or your financial planner. He'll be more than happy to assist you. Hopefully you found some of this useful. As always, if anyone has any suggestions on topics or areas that you'd like us to cover, please do let us know, and we'll gladly pick that up in the future. But from me, just thank you for listening, and hopefully catch you next time. Cheers.